So let's look at conventional banking versus infinite banking. What's the difference? Well, conventionally today, you are allowing somebody else to control the banking function in your life. When you become your own banker, utilizing the infinite banking concept, you now reap the benefits that you're currently giving up to the commercial banks. Okay, but we're not changing anything about our financial lives. All we're doing is reclaiming the banking function, something that we're already doing all day, every day, without thinking about it. But instead of letting Wells Fargo control our cash flow and letting Wells Fargo profit from providing us with banking services, we're just going to reclaim that function for ourselves. So let's take a look at this. So this is what we do today using somebody else's bank. We take $1 and we deposit it into our bank account. Someone else's bank, not our own. So we have $1 in the bank. Hopefully we're earning interest on it. Hopefully it's good competitive rate. Okay. Then at some point we might need to use that $1. So we take that $1 out and we spend it or invest it or do whatever we were going to do with it. Now we're no longer earning interest on that $1 in our bank, and that $1 is gone from our bank account. This is the way it works when you use someone else's bank. Now let's contrast that to using your own private bank. So here we are. Let's say we're in year 5 of becoming our own bankers. We're going to take that $1 and we're going to deposit it into not somebody else's bank, but our own private bank account. And our account balance grows not by $1, but by $1.19 immediately. We're earning interest, just like in somebody else's bank, okay? And now, let's say we want to use that $1. So we take that $1 and we use it. And yet, we are still earning interest on that $1 inside of our own private bank, even while we're using it. And this bank ages like a fine wine. So let's look 5 years down the road. 5 years down the road, we take $1, we deposit it into our private bank account. Our account balance now grows by $1.46 immediately, thanks to the power of sound banking that we control rather than unsound banking that somebody else controls. We're earning interest on it, of course. And if we take that $1 and use it, we don't interrupt the interest we're earning inside of our private bank. So every time we deposit $1, we get more than $1 of account balance growth, and that gets better every single year. And when we use the dollars in our private bank account, we are still earning interest on those dollars. Sound too good to be true? Maybe it does. So how do you become your own banker? How do you reclaim control of the banking function for yourself? Well, in your own private bank account, all your cash keeps earning, even while you're using it. How so? Well, we take that $1 and we deposit it into our own private bank, namely custom designed cash value life insurance. You're going to take that money and you're going to pay it as a premium into your specially designed cash value life insurance policy, where you now have that cash value available to you in your policy. And it's going to grow $1.19 of cash value for every $1 you pay in this example. And you're going to be earning interest in the form of a guaranteed interest rate. Your cash value grows at a guaranteed interest rate by the insurance company from now until the day you die, and also dividends. Because when you take out these, again, very unique policies, you become part owner of the mutual insurance company you're working with, which entitles you to a dividend. So your cash value earns interest at a guaranteed rate and dividends. When you go to use that $1, you're not going to withdraw anything. You're going to borrow against your policy using what's called a policy loan. This is how we keep earning interest on the entire balance, because we're never withdrawing anything. We're just strategically borrowing against it. So we use that $1. Meanwhile, the $1 keeps earning for us inside the policy. And on that policy loan, there are no repayment terms whatsoever. A policy loan is not a debt. This is what we mean when we say you become your own banker. What happened conceptually is you issued a loan from your own private bank to yourself, and you now decide what the repayment terms of that loan are. Meanwhile, you keep earning on the entire principal balance. So all those dollars that would have left your personal economy had you spent them now stay captured and earning inside your personal economy even while you're using them via a policy loan. So we're still earning interest on these dollars because we never withdrew anything. The entire principal balance is still earning for us. So infinite banking is the process of becoming your own banker using custom-designed cash value life insurance. So what we're talking about here is the banking process, something that a lot of people are not familiar with. And then the vehicle that we use is specially designed cash value life insurance. But it is important to make that distinction. We're becoming our own bankers. Cash value life insurance happens to be the vehicle that we're using, but infinite banking does not equate to cash value life insurance. These have to be specially designed policies utilized in the right fashion. Otherwise, we're not really becoming our own bankers. We're just buying cash value life insurance, which is fine, but not necessarily enabling you to become your own bankers. And it is a process. It takes time. The most important element here is the passage of time. So what's the drawback? So far, it seems just amazing, right? What's the drawback? Well, there is a drawback. There are costs associated with this. So what is that? Well, notice I started looking at this in year 5. What's the drawback? Well, this is a long-range strategy. Here's the drawback. Let's look at year 1. Rewind a bit. In year 1, we take that dollar and pay it as a premium into our custom-designed cash value life insurance policy. In year 1, our account balance only grows by 38 cents in this example. And by the way, there is a real policy behind this. These numbers are not made up. So for every dollar we pay in premium into the policy in year 1, we only get 38 cents of cash value growth. The insurance company that we're partnering with has to make money too. Okay, fast forward to year 4, and it's getting better every year. In year 4, we pay that same dollar in, and our account balance now grows by 97 cents. So we're almost breaking even by year 4, and then year 5 is when we are off to the races. So if we could just magically start this policy in year 5, it's a total no-brainer. And that would be too good to be true. But this shows you it's not too good to be true. There is a cost associated with setting up your own private bank. So again, it's not until year 5 that we really start becoming cash flow positive. The first 4 years, we can still use the cash value. We can absolutely take out policy loans and engage in the banking process. We just won't have full liquidity until year 5. So it's not too good to be true. It's too good to be free.